Senior Territory Credit Manager with Kubota Tractor. George has been in the credit field for over 20 years and has been an instructor for over 15 of those. He received his master's degree in organizational management from the University of Phoenix and is certified C2C executive advisory speaker, having presented on webcasts as well as their advisory forum. He is a true supporter of the Building Blocks community, even just presented at one of our luncheons a few months back. George, we are glad to have you today. Thank you for joining us, and the floor is yours.
All right, thank you. Okay, so today we're going to talk about credit risk management, how to assess, prevent, and reduce as far as risk. So keep in mind with the changing as far as dynamics going in today's economy, there's a lot of changes that are happening, a lot of things that we really need to kind of monitor. And one of the big things from a credit perspective, how do we manage as far as the risk? How do we decide, hey, let's go ahead and approve this different sales. Let's go ahead and do this and do that. In today's market, there's a lot of things that are changing, and very important that we're on top of our A game to handle as far as the different risk. So today, what I'm going to do is I'm going to go in, I'm going to define what is credit risk, because once again, we need to understand what the credit risk is. Second thing that we're going to talk about is why is credit risk management so important? So once again, like I said, the market, everything's kind of changing in today's realm as far as what's happening. So we really need to be on our A game. And then the other thing, I'll go through some of the different objectives of the presentation. So let's go ahead and start by defining what is credit risk. Probably that's one of the main things that we should go over, and one of the main things that will start our conversation. So credit risk refers to the potential loss from customers failing to meet as far as payment obligations. So our goal from a credit perspective is to get the good customers to spend, but guess what? We also want them to pay. So once again, trying to determine who our good customers are versus as far as our bad customers. And if we can't find that right balance, we're going to run into cash flow issues and financial losses. And that's kind of one of the big things. I gave a presentation about 2 weeks ago on tariffs, and that's one of the big things that we talk about is, hey, what's going on with some of the different risks out there? What's going on with some of the different tariffs? And what's going to prevent our customers from paying us? End of the day, it's all about us. We want to get paid. We want to control that risk. So some of the things that we can do to start with, what we need to do is assess new and existing customers. So with our new customers, very important in today's atmosphere to go in and look to decide, hey, are these customers warrant as far as credit? Should we go in and give them different terms? What should we do with as far as these new customers? And better yet, you know, they want to buy from us, which is great, but let's give them options. If they can't pay us, let's go ahead and put it by as far as credit card prepayment, and then go ahead and give terms as they establish with us. Other thing to keep in mind too, and the second part of this first bullet really says a lot too, we also need to go in and look at our existing customers. Existing customers, keep in mind their financial landscape is probably changing also. So do we need to go in? Do we need to raise? Do we need to lower as far as their credit lines? What can we do to go in and monitor as far as what's happening? So with your existing customers, I like to say monitor, reevaluate, see, does it make sense for them to have, let's say, $100,000 limit? In today's economy, maybe instead of 100,000, we bring them down to 80,000. So there are different things that we need to look for. And better yet, if they're paying, then that might lead us to go ahead and increase their credit limit. Second bullet on there, look at as far as the financial health. So we should have metrics in our system to go in and look at the financial health. How are these customers paying? For example, what is their DSO? Are they paying on time? Are they paying 30 days on top of their terms? what's going on with these particular customers. And the big one on there is the payment behavior. Are they paying on time? Are they splitting their payments? What is causing as far as their particular behavior? A lot of the different systems that are out there these days, if you're using as far as a financial system, they may monitor as far as how they pay. They could forecast when your customer is going to make their payment. But if we notice all of a sudden, instead of paying us at day 30, they're now paying us at day 60, that might be an indicator we need to have a conversation. Other thing to keep in mind, think of the external factors that are impacting the customer credit worthiness. Once again, tariffs. If they have to add additional cost to their business, maybe they're not passing that along to as far as their end customer. So that in turn may be impacting as far as their cash flow. So we need to really kind of look at that, talk to them, figure out what's going on. And through this presentation, one thing I would push with this, know as far as your customer, have those different conversations. Ask, hey, how is your business doing? How are your customers paying you? Because if their customers are slowing down paying them, there's a good chance that they're going to slow down paying us. So once again, ask those questions, really get to the bottom of what's happening with your particular customer. Now, other things that we can do if we want, and this is probably a good thing to go ahead and do. So if we're going to go in and submit as far as new applications, one of the first things that we should do is go in, look at the business and the financial details. How solid is the company? How long have they been around? What is their score? So that we'll get into that in some of the next slides. Obtain as far as different references from other suppliers. So how are they paying other suppliers? I mean, that's a good indicator of how they may end up paying you. So once again, ask for references and verify that. And the third one, I like to ensure that we get this on every credit application, get that tax ID. That tax ID is part of your legal documentation. The big thing with that tax ID is if they have several different business names, but they use that same tax ID, that's what everything is tied to, that tax ID. So very important that we have that. Other thing that you may find on some of these new credit applications, they may already have an account within as far as your business. So that's why if everything's tied to that tax ID, you'll be able to find that in your system. All right, so other things that you can do, you want to pull as far as the different credit reports and the Dun & Bradstreet. So Dun & Bradstreet is going to give you as far as the credit history. Keep in mind, as we look at these different reports, it's giving you history. It's not giving you 100% forecast, but it's giving you an indicator how they've paid in the past. So Dun & Bradstreet, are they paying on time? How are they paying as far as their other creditors? This would be once again for a business. We also have as far as Equifax, Experian, and TransUnion. This would be more from a personal standpoint. So if you're dealing directly with the end customer, this would be as far as their personal credit. So this would be business to customer. Credit Safe, another great as far as organization to use to give you some insight how they're paying. And the other thing that you want to do is look for different red flags. So look for, do they have high debt? Do they have as far as late payments? And as you're pulling this information, you want to bring it to their attention. Hey, I ran this report. Can you give me a little more insight? What's going on with your business? So for example, maybe it's a new business. They will have high debt because they're just starting out. Late payments, maybe there's a story behind it. And if we ask, maybe they'll provide us with that information. So once again, that will help us determine, well, what type of credit limit we should grant them or what type of terms. Now, other thing that we need to look at when we look at the different reports, we need to go in and look for as far as the trade references. So once again, how are they paying as far as some of our competitors? How are they paying as far as other vendors? That's a big thing. Look for the payment history, kind of the same thing with the trade references. And the other thing that you should look for, depending on your industry, look to see how those particular industries pay. So look for those different trends. So, for example, like medical tends to pay, I'm going to kind of say this lightly, but medical tends to go a little further out with as far as their payment terms, where some of the other construction may be right on time. But that's one of those things you have to go industry by industry to see, well, what is the norm? How is the different industry based on? And one of the things to keep in mind with the different industries, you may have to go in and update your terms to mirror some of those different industries. But the goal is hey, do they normally have 30-day terms and how are they paying? But once again, I need to look to see what those particular trends are. And when it says the different trends, keep in mind different industries may be slow during different parts of the year and may pick up other parts of the year. So that might be kind of a indicator, hey, that's what's happening throughout the industry. Now, some other things that we should look for, was the customer a previous account holder? So this is what we should be looking in our particular system. So remember when I was saying about the tax ID, that's why the tax ID is so important, because that might be a way for us to go ahead and find that they were a previous customer. And if they were a previous customer, how do they pay us? There has to be a reason why they came back. I mean, obviously we want them to purchase, but once again, how did they pay us before? Did they have late payments? Did they have some defaults? One thing you may find with some of your different customers is they're going to shop around. As soon as one supplier puts them on hold, they're going to go to the other supplier. So they're going to go between the different suppliers to get their particular products. Other thing at the very bottom, do they have a business with other part of our business? So a relationship with other parts of our business. So that would be a good thing to know, because if so, you could go ahead and reach out to the other part of the business and say, how are they paying you? What's going on? Any particular as far as issues or any things that we should be aware of. So we may need to reach out and ask as far as those questions. Other thing to keep in mind with other parts of the business that may be set up differently, they may have different terms, there may be a different story, but that's a discussion you want to have with the other part of the business to see how they look at that particular customer. Now, something else that we need to think about how we could go in and look at as far as our customer to see, hey, what can we do to set as far as the different terms? What are some of the different things for us to look at? So we need to evaluate the financial strength and payment history. So find a way to go in and score as far as how they've paid us in the past and the payment history. So we may need to set as far as standards in our system to say, hey, this is something that we need to score, and the financial strength will be based on as far as the pay history. Maybe for the different terms, they could only be late maybe 2 times, and then they're going to get the best as far as terms. If they're late 3 or 4 times, then we take them down to a different term rate. So kind of the thing, what I'm leading to here, set the different limits based on the risk tolerance. The higher as far as the risk, then once again, we need to set the limits differently. We need to adjust the limits as necessary. So keep in mind with the different limits that the limits themselves will change. So if the limits do change, we need to go in and adjust. But one of the things that you should be looking for is if their financial strength is deteriorating, then we need to bring that limit down. If, on the other hand, they're doing great, the business is taken off, maybe we need to adjust as far as that limit and take as far as that limit up. So once again, look at that financial strength and look at the pay history. Some other things that we should be doing going forward, and this is something where I think some businesses kind of miss as far as the ball on this one, have ongoing credit monitoring. So with the ongoing credit monitoring, what we're trying to do is determine, hey, has their credit score changed? What's going on with their particular score? So the ongoing credit monitoring, it's going to notify you, hey, the score went up or hey, the score went down. And then based on that information, we may need to do some digging to say, okay, based on that, do we need to lower as far as their credit? So once again, look at that. Other thing that you may want to do, depending on as far as the dollar amount, look at their customer financials. So I work for Kubota Tractor Corporation, and we actually look at our different dealers. We look at their financials on an annual basis. Given what's going on in the economy, we're kind of changing that and saying, hey, maybe rather than looking at it once a year, maybe we need to look at it throughout the year. So regularly review those customer financials, and financials should be able to tell you as far as a story, tell you what's going on with as far as their business. And keep in mind, there's going to be different lulls within as far as the customer's business. There may be different seasonal as far as adjustments to as far as their business, but we should be able to look at that and compare to previous years, previous quarters, previous months, however we have it set in our system to kind of track what's happening with as far as their business. And finally, the bottom one there, the communication is key. Keep as far as that communication open with as far as customers. One thing I've noticed in the business that I'm currently in, the better we communicate with as far as the customers, the better we could solve as far as different issues. And the other thing that I've also noticed is it's a win-win. If we help them as far as with what they're doing with their customers, we're trying to help them sell as far as our particular product. So if they sell, we're happy, they're happy. So try to keep as far as that open communication. And the bigger thing with that, as you hear or see things, bring it to as far as their attention and try to work through some of the different issues before they become bigger issues. Now, other things that we should be doing to monitor as far as the different payments. So one of the things that you should be tracking, and you should already be doing this, track on time versus as far as late payments. Depending on your system, this should already be in your system. So you should be able to look at that and say, okay, for the last 6 months, they paid us on time, let's say 4 or 5 times. One time they were late. And then hopefully if they're late, we should have notes in the system saying why they were late. Other thing that we should be doing with as far as the pay history, identify the different patterns of delayed payments. What are the different patterns? What are the different things causing the delayed payments? The better we could focus on that, the better we could go ahead and solve the issue before it gets out of hand. So maybe what happens is that's a slow time of the year, causing them to have as far as delayed payments. Maybe we monitor it closely. Maybe we bring as far as the credit line down. So we need to know and understand why we have those delayed payments. And then the bottom one there, address issues proactively. So the sooner we know as far as the different issues, the better we could go ahead and address as far as the issues. So by being proactive, that will help us prevent as far as future problems. So once again, address the issues proactively. Other thing we could do from a financial standpoint, look at as far as the balance sheets. So like I said before, with as far as the financials, if you're looking at this once, twice a year, or whenever as far as needed, look at as far as their balance sheets, look at their profit and loss statements. Once again, you should be looking at these, but you should be comparing year over year, month over month, quarter over quarter, and looking to see kind of what's going on with as far as the business. For example, is their income going up? Is their expenses going up? What's happening in there? And this is kind of one of those things I like to say, if you look at the numbers, it's going to tell you the story. So you may have to dig a little further to get the end results of the particular story, but you'll see once again what's causing as far as the story to occur there. Other thing to keep in mind, what is causing the different changes in the financial health? So maybe, for example, they lost one of their biggest clients. So if they lost one of their bigger clients, guess what? They've lost some different income. So that could have a big impact on their particular business. Or better yet, now all of a sudden they've got a new, as far as client that's taken off. And because of that, their sales have gone out of, increased. So once again, that would be something for us to look for. And then the other thing, once again, I know we keep coming back to this, but adjust the credit terms accordingly. So if we're noticing things are happening on their cash side, their cash is dropping, then we need to go ahead and drop as far as their credit limit. If on the other hand, sales are going up, then maybe we need to alert our sales team, hey, reach out to them. Let's go ahead and increase as far as their credit limit, and let's get them out there as far as buying additional product. But once again, we need to know what's happening with their financials. Now, something else that you really need to think about as you go through this, and I can't say this enough, have as far as that regular communication. The more communication you can have, the more trust that you will have. The trust should be from both sides. So it should be coming not only from you to the customer, but from the customer to you. The better the communication, the more information that's going to be shared. And at the end of the day, they should understand you're trying to work with them to help them grow as far as their business. But at the same token, you also need to understand you're trying to control as far as your risk. So once again, that trust it's a must. Second one on there, their financial situation. The more trust you have with as far as your customers, the more they're going to share with you. So understand what's happening with their financial situation. So what is causing the different changes with their financial situation? And it may not be necessarily negative. It's just one of those, once again, we need to understand what's happening. Better we understand the industry, the better we understand as far as their business, the more we can help them. And I think the bottom one, kind of going through the different slides, kind of said this, throughout the last couple slides, the more we could be proactive, the better we could be as far as addressing the potential issues. We know that there will probably be some issues with the different sales. We'll see different changes. So we just need to know, once again, hey, we need to get these addressed and move forward. And the other thing with as far as the potential issues, think of it from this perspective. If they're going to deduct something, we don't want them deducting something month over month over month. We'd rather find out why they're deducting so we could go ahead and address this and then move forward. Some other things to consider as we look at this, different industry trends. That's what we're seeing in today's market. Impact as far as customer cash flow. So think once again, what's happening in the particular industry. For example, I'm in the tractor industry with Kubota Tractor Corporation, and one thing we're noticing is people aren't spending as much as they were in the past. Well, what's going on in the industry? Things are a little slow right now, and one of the things that we've noticed is some customers are kind of afraid with some of the different tariffs. They don't want to spend a lot of money at this time, so things are kind of slowing down a little bit. Doesn't mean it's not going to pick up. That's kind of what's happening at this particular moment. Economic downturns, once again, kind of what we're going through right now. Sector specific as far as risk. That's why it's always good to look at the particular group and break it down by different sectors. So, what's happening with that particular group? And then the other thing at the very bottom, adjust your different credit policies based on what's happening in the particular market. If you have that trust with as far as your customer, they'll hopefully understand that you're looking out for them as much as you're looking out for as far as your company. So once again, we need to kind of find that right line and really kind of what can we do to make it a win-win for both parties. Now, something else that you can do, and this will kind of help you stay ahead of as far as the curve, as much as possible, if you could get a program to go in and monitor as far as what you're doing using predictive analytics. So, for example, we had as far as a system that would go in and they would tell us, hey, your customers pay at day 40 over and over again. So they were actually able to forecast and tell us, hey, for the next week, this is how much you should receive for your particular payments. And it was pretty interesting because it was pretty spot on because the system knew, hey, they always pay at such and such date. So they'll look at as far as what's due and they'll look at that and say, okay, they pay 5 days over. So 5 days over, this is when they're going to make as far as their payment. So that predictive analytics is huge. That is something that you want to look for. Other thing, identify as far as warning signs early. So are there any warning signs of what's going on? So, like I said before, with some of the different tariffs, some of the different things that are happening out there, what is causing some of those different changes? So, we need to know and understand that. And the bottom one there, adjust the credit terms proactively. So, if things are starting to slow down, if you're thinking, hey, there's a lot of risk going on out there in the market, maybe we need to go in and start reviewing as far as the different credit lines and proactively going in and adjust them. So that controls as far as the risk. It's not saying that we're not going to approve everything. It's just saying that we need to look further into it and be a little more cautious in what we're doing. Other things that you could do to help minimize as far as your risk, diversify as far as your customer base. So having a mix of different customers, customer base is good because having that mixture, what that will do is if one goes down, then the other one will as far as pick up. So diversifying is good because once again, you don't have all your eggs per se in one basket. So think of as far as your different customer base, what else can we sell? What are some of the other things that we can do to minimize the risk to the overall as far as business? And that's what you're trying to do by diversifying, is allowing as far as one side to maybe be a little risky, but the other side will kind of absorb the rest of the business. Other thing, if you can, and this is a way to entice your customers, maybe we give them early payment discounts. So if we're able to go in and offer early payment discounts, we may want to go in and do that. That would be a good way to get them to pay earlier. And at the end of the day, yes, it's a discount, but guess what? Money coming in early is better than money coming in late. So the sooner, and I think this is one thing most people miss, the sooner we get the money in the door, the sooner we can reinvest into our business. So we want that money to come in sooner versus as far as later. Other thing, using factoring or trade credit insurance. And basically what this does as far as with the factoring or trade credit insurance, that prevents a big loss to us. That trade credit insurance, what we're trying to do is buy insurance to minimize as far as our risk. So we may need to go in and do that, especially on some of our bigger, as far as customers, some of our bigger sales, we may need to look at that and say, okay, do we need that trade insurance to kind of help as far as prevent a future loss if it should occur? Now, as far as delinquent accounts, big thing with this, we should have a process for collecting. So this is something where at this point we need to be on top of as far as our delinquent accounts. So for example, I used to spend about 3 hours a week doing nothing but running reports. The reason I ran the different reports is so I knew exactly who the customers were that we had the different issues. I would take that information, give it to my credit reps to go ahead and collect. I would also share it with our sales establishment, to our sales group. So they in turn could also reach out to as far as the customers to kind of help us with collecting. And then the other thing what that would do is also alert that, hey, these customers may go on hold. So we need to be on top of this to prevent that from happening. The second one, when needed. So I'm going to say when needed. I'm not going to say this should be something that we do all the time, but maybe we need to offer a payment plan, like it says here, when appropriate. So if we know one of our established customers is running into a slow time, maybe we offer as far as a payment plan for them. Not something that we would normally do, but we want to keep them on board. And maybe what we do is say, we're going to put you on a payment plan. Until you pay this off, all future sales will be prepaid. Once you pay this off, then you're back to normal terms. So this was one where we need to have that conversation and work directly with our customer. The bottom one, knowing when to escalate to legal action. So one of the things you should look at also with your delinquent accounts, hey, you've gone through your process. You've tried to work with your customers. From time to time, you may have customers that you need to send to a third-party collection agency. So have it go through the third-party collection agency. If needed at that point, then maybe you need to take that legal action. But try everything you can to get your customer to pay and once again, work directly with them. The better your accounts are as far as with their DSO, which we'll see here in a second, the easier it's going to be to keep a handle on the delinquent accounts. And nice thing is when everything's paid on time, but we all know that doesn't always happen. So we need to just stay on top of it and prevent it from getting out of control if we happen to see a slew of accounts go delinquent. Now, other thing that you can do, and this is kind of what I was alluding to earlier in some of the previous slides, look for a credit risk management system. So look on this. Handle has a great system to help you with this. So look at the credit risk software and automation. So take all that in consideration. Let them come in and do the analytics behind the scenes. And basically what they're going to do is say, hey, this is what we think is a risk. Go ahead and work it. Or, hey, we need to go ahead and basically put different alerts into the system so that you know, hey, this is a risk. So the higher the risk, the more emphasis should be put on those particular accounts. Other thing, AI-powered credit and analysis. So let AI come in and review that. When you think about as far as what's in your system, it's numbers, a lot of different numbers, and you're going to put different ranges on when people should pay, what the delinquency is, etc. So let AI come in and do as far as the credit analysis. Other thing that I like, and this is what I did at one of my last places I worked at, integrate the credit data with your ERP systems. So take as far as that credit data, put it into your ERP system, let that drive some of the decision making in your system. So in other words, hey, it's a high risk. We're forecasting that they're going to run into some financial issues. Once again, it's not saying that we're going to say no, it's saying, hey, we need to review this more. So we need to really take into consideration what the system's telling us. So look at the credit data, let it kind of give as far as the information, tie that into your ERP system. Other thing with as far as this information, when it goes in the ERP system, It could also tell your collectors, okay, here's the accounts you need to focus on. Here's the accounts that you need to go ahead and collect on. It could really go in and give you as far as the handle on, hey, this is where we need to put our focus. That's where you really need to let the data give you as far as that information. Other thing, I'd like to kind of take a step back and kind of look at this and think about from a real world example. What are some of the best business practices out there? There may be things that some of the bigger companies have that you don't have, but they may have some of the different practices that you could glean from. So think of what are they doing? What are some of their procedures? Go to some of the different conferences if possible. NACM does a great one, CFDD does a great one, IOFM does a great one. Go to some of the different meetings and sit in some of the different conferences and what are some of the best practices? What are they doing and what can I do to glean the information from them? There's always something behind the scenes that you can learn and learn from the ones that are doing as far as the best. And the bottom one there, what did they do to reduce their credit risk and improve their cash flow? So one of the things that you have to think about, and it says it right there, what did they do to reduce their credit risk? They didn't say no to all their orders, but what did they do to reduce as far as the risk with still getting the cash coming in? End of the day, if you're going to shut the door, you're going to lose as far as customers. But if you find that right balance, you're going to get the sales coming through and you're going to reduce as far as your risk. End of the day, once again, we need that improved cash flow. That's a huge must. So some of the key takeaways that we need to look for, and hopefully throughout this presentation, you've kind of looked at this and heard some of the things I've stated. So one of the first things, the importance of credit risk management. So that's a huge thing to look for, especially in today's environment. You know, when everything's going great, you don't have to worry too much about the credit risk. But when you start seeing things slide a little bit, see the market change, whether it's the tariffs, whether it's slow pay, etc., you really need to go in there and manage. So that credit risk management is a must. Look for best practices for managing customer accounts. So one of the things for managing your customer accounts, maybe you segment your customers and maybe your best customers you review periodically, but you don't have to spend a lot of time on. Maybe some of your risky customers you spend more time on. And because of that, you keep trying to bring them up to as far as higher up in the way they pay as far as their payments. So once again, manage your accounts and figure out a way to segment them. And I think the big thing with the second bullet there, you can't always work all your accounts the same. So you may have to segment them and certain accounts get worked one way, other accounts get worked another way. So we need to look for the best practices for each segment. Other thing, be proactive to minimize as far as the risk. Know what's happening with as far as your portfolio. Know what's happening with as far as the industry. What are some of the different things that we can do to minimize as far as the risk? So if I happen to know in my industry that there are changes coming, maybe I know, hey, such and such dealer is no longer going to be with us, or some of the different competitors, some of the different vendors are changing the way they operate, then I may need to adjust our practices, our accounts, and really look to minimize as far as that risk. End of the day, once again, going to say it again, our goal is to minimize as far as our loss. Same token, we also want to increase as far as our sales, but we're trying to find that right balance as we go through as far as this. All right, that brings us up to questions and answers.
George, I want to thank you again for stepping up in this community and speaking and presenting on this topic. It's a great topic. And for everybody that joined us, thank you for taking time out of your day. And we hope to see everybody at the next one.